Welcome to the MCEC Connecting to the Energy Economy Speaker Series, and the first of 10 sessions that we have scheduled in the series. We have a great kickoff session this morning entitled State of the Sector, Impacts on the Energy Economy. My name is Kathy Magruder. I'm the Executive Director of the Maryland Clean Energy Center, and I especially want to thank our sponsors for their support of this program. We want our audience participation during the series, so we will be asking you to respond to a few polling questions. Let's get started with a few technical housekeeping items. So we want to start with one polling question that will give us a bit of information about the size of the group joining us today for practice. Remember, to answer a poll question, click on the radio button next to your answers, and then click Submit. The results from our poll will show up shortly on your screen, and you'll be using the polling feature a few times today during the session, so this will give you a little bit of practice. Great, so it's a lot of people all by themselves. The quarantine is still live. So our second live polling question is, which industry sector do you represent? There are a number of categories. Remember, to answer a poll question, you can click on the radio button next to your answers and then click Submit. Our host will close the poll after a few seconds, and then the results will be displayed. There you go. Now you know who you are today. Once again, as part of the webinar series, we hope you'll be able to join us for all of the future sessions. Recordings of each session and additional information, as well as past session recordings, will be found online at www.mdcleanenergy.org/speaker-series. The session today is brought to you by our sponsor, CohnReznick, who has sponsored the entire series. MCEC would like to recognize CohnReznick for their help and other sponsors. And it's my pleasure to invite our moderator, Lee Peterson, who is the Senior Manager at CohnReznick. He'll be welcoming our panelists. Lee is in charge of transaction and turnaround for renewable energy project finance and consulting practice. Since 2004, he's been a critical tax advisor in billions of dollars of renewable energy projects within the U.S. and its territories. He is also responsible for thought leadership and energy-related government affairs. His clients include Fortune 100 companies, domestic and foreign, renewable energy, project developers, investors, and manufacturers, and we're very fortunate to have Lee moderating our session today. Thanks, Lee.
Well, thank you, Kathy. I'm honored to be here, and it's a privilege to be in the company of Jim, Pat, and Greg, who are consummate professionals and extremely experienced folks. So we have a great lineup of speakers today. At the end of the program, we'll have time for Q&A. So please remember that questions for the panelists can be submitted via the Q&A feature, actually at any time during the presentation. And you can use the chat box if you need technical support. But again, just to be clear, we're going to have sort of Q&A in between each presenter, so you can ask questions specific to the presentation portion you just saw, and then at the end we'll have additional Q&A. So there'll be multiple opportunities to send your questions over. Again, we have another polling question here. We'd like to ask you a few projections related to electricity prices and when you think workers will be returning to traditional office settings. Remember, to answer the poll question, you click on the radio button next to your answers and then click Submit. And so the question, of course, is 5 years from now, do you foresee commodity electricity prices will be A, 50% lower, B, about the same as today, C, 50% higher, D, 100% higher, or E, over 100%. So we'll share these polling results at the end of today's sessions. We also have polling question number 4, and that is, of course, when do you anticipate the majority of workers will return to offices? A, October 20th, I should say October 2020, January 2021, June 2021, or sometime in 2022, and E, let's hope it's not true, never. But if you could take a quick second and give us your thoughts on that, we would deeply appreciate that. Now I'd like to introduce our first panelist, Jim McDonnell, Chief Operating Officer, Avalon Energy Services. Jim is the Chief Operating Officer of Avalon Energy Services. Prior to Avalon Energy, Jim was the CFO of Pepco Energy Services. He's also worked as a field engineer for Dresser Atlas, a manager with Anderson Consulting, and a vice president with the Columbia Energy Group. Jim is past president of the National Capital Area Chapter, NCAC, of the U.S. Association of Energy Economics, and he has a wealth of knowledge and experience, so I'm actually really looking forward to the detailed presentation. Jim, it's in your hands now. We'd like to hear what you've got to present.
Can you hear me?
Can hear you now, yes, please go ahead.
Great. Okay, Pam, could you flip to the next slide? So thank you very much, Lee, and thank you to the MCEC. So I plan to cover today 2 things. So first, a very broad overview of energy markets, looking back in time, and then also what the markets say about the future. And then secondly, a look at how the pandemic has affected electricity usage in PJM with a specific focus on commercial real estate. So I'm going to move through the energy market slides pretty quickly to get some more local issues. So starting with this, so this shows the mix of generation nationwide back to 1996, and the trends are dramatic. So you see the decline in coal in blue, offset by the rise of natural gas in red, and renewables in purple. If you go to the next slide, please. So more closely, concerning the decline of coal, the inexpensive natural gas and renewable, inexpensive natural gas and renewable energy have continued to pressure coal. Coal retirements peaked in 2015. The pace of retirements has slowed recently. About half of the U.S. coal fleet has been retired or is planned to be retired out of 320 or so gigawatts. Natural gas, you see on the graph in the middle, the dramatic increase in unconventional natural gas production in blue. Or you see total natural gas production in blue going from about 50 BCF a day to over 95 or 96 BCF a day, and since falling off to about 88. But the real story is the red line. Within that total natural gas production, shale gas has grown to be about 80% of total production, up from a de minimis amount in the year 2000. Excuse me. And then on the bottom, you see the rise of renewable energy. Last year, about 17% renewable energy nationwide came from renewable energy, and about 11% of that from non-hydro renewables. So, so this shows a closer look at PJM, and the story is the same: the rise of coal in red. I'm sorry, the decline of coal in blue, and the rise of natural gas in red. So, if you would advance to the next slide, the rise of renewable energy in PJM continues to accelerate. In part due to some of the rather aggressive RPS standards and healthy SREC prices. So the left graph shows the 3 iterations of the RPS in Maryland. 2004, the goal was 15%. In 2017, that was raised to 25%. And then last year, that was doubled to 50%, which is very aggressive. And then on the right, you see the solar carve-out, which was increased to 14% in the last iteration, which is a very high percentage compared to other states. Then concerning SREC prices, you see the District of Columbia leads the pack with north of $400 a megawatt hour pricing. Maryland at 73, that's a significant increase from about $20 a megawatt hour, say 2 years ago. It really took a jump with the new RPS. So So when we think about electricity prices, we need to start with natural gas prices. So if you would please, thank you. On the left, you see how electricity prices and natural gas prices have largely tracked each other. So you can see it visually on the left. On the right is a more statistical look at it, where the average correlation over, this is back to 2001, is about 64%, meaning changes in natural gas prices account for about 64% of the change in electricity prices. So here takes a real long-term view, looking back in time to natural gas prices back to 1976 or 44 years ago. See in the blue line, these are nominal dollars of the day, and you see the average price was about $2.90 over that period, and the trend was upward sloping or rising. 44 years is a long time, so we converted all these prices to today's dollars, adjusted for inflation. And when you do that, you get the red line, which shows an average price of about $4.60 and a more sideways trend. The bottom line here is natural gas prices are really low today, and they have been since even before the pandemic. If you would switch ahead. This looks also at electricity prices, specifically PJM West. Again, the blue line is nominal prices, and the red line adjusted for inflation. Nominal prices, the average price was about $50 a megawatt hour over that period, and once adjusted for inflation, it's more like $60. Point here is electricity prices are really low today and have been since before the pandemic. So looking ahead, so what does the market tell us about future natural gas prices? And so here we look to the forward market. So there's a lot to this graph, but I'll just point you to this. This shows the change in, excuse me, in the forward curve over the last 10 years. So starting at the top left, you see the forward curve started at about $4.50 and rose up to $6.50. Up, very upward sloping, very peaky. Over time, over the last 10 years, that curve has shifted down and turned more sideways to the red line, which was June 25th of this year, where the prompt month, or the first month in the forward curve, hit $1.48. And you can see it's flattened. The summer-winter differentials lessened because of more power burn. And again, so we've seen historic prices low. Now we're seeing the market telling us that prices may be lower for a long time. So if you'd switch to the next one. So this looks at the forward curve on the left side a year ago. The blue line is a year ago, and the red line is the red line we just saw. So except for the near months in the forward curve, really the curves are not that much different. If you look to the right, this is from last Thursday when Hurricane Laura was bearing down the coast, Gulf Coast. The curve has definitely risen, but if you put it in context, the average price over the 44 years has been, in real dollars, $4.50. We're bouncing between $2.50 and $3.25. Go ahead. So putting the two together, the red line shows historical prices in real terms, and the blue line on the right shows the forward market over the next 5 years. So again, the point is natural gas prices are really low, and the market expects them to remain low for some time. And then if you go to the next one, this one just looks at the average monthly high price and monthly low price. Those are the bars. The red line is the forward curve we just looked at from June. So, looking back over 5 years, we're roughly in the middle-ish. And price, like I said before, prices have been relatively low over the last 5 years. If you go to the full 44 years on the bottom, the forward curve is scraping across the bottom. I mean, prices are really, really low. So, but the market is not always a good predictor of future prices. So if you switch to the next slide, I'm not going to go through these one by one, but on the left are sort of the traditional consideration and market watchers track and scrutinize very closely in trying to predict where prices may be headed. On the right, I've listed some increasingly influential factors. And to summarize, it would be changing societal priorities, the electrification of the economy, moratoriums on gas hookups, resistance to new infrastructure, both gas and electric, the divestment movement, keep it in the ground movement, maybe more significantly, the industry, oil and gas industry unprofitability and recent slew of bankruptcies are all leading to uncertainty, and uncertainty leads to volatility. So I think that's what we can say about the future. And probably the biggest uncertain item is what are the next energy revolutions? And I mean, who knows? You look back 10 years, the decline of the cost of solar panels and the decline of delivered renewable energy. What lies ahead? I mean, there are many things we can't even think of right now. So moving on. So okay, so now switching gears to demand destruction. If you advance to the next one, please. So this data is from a supplier survey of 12,000 meters in PJM and matches up pretty well with what we see with our customers. These are year-over-year comparisons. So if you look at May, things kind of bottomed out in May and have recovered quite a bit since then. Should note this is C&I customers, residential customers usage has actually gone up, which makes sense given the work at home that we're seeing. I also want to note that total degree days for this March through July period this year were higher than total degree days for the same period last year, meaning everything else constant, you would have expected more energy use this year. So these declines in energy usage may actually be understated if you were to adjust it for weather. The things to note here are there's quite a bit of variation of the impact across industries. So if you look at healthcare and government, they took hits down in May to 15 and 19% compared lower than last year. But if you look at hospitals and hotels and hospitality, 45% entertainment, casinos and so on, movie theaters, and also 45% decline. So it's been quite varied across industry, but also the impact has been uneven within industry. So for example, within hospitals, urgent care or hospitals have focused on, have been assisting or helping customers, COVID patients didn't see much of a decline versus hospitals that are more focused on elective surgery, their drop was significantly greater. Another example, hotels, high-end hotels that cater to business travelers saw the most dramatic drop versus more limited service hotels like those you might drive to rather than fly to, and extended stay hotels like those housing essential workers like medical workers or fared better. So if you flip to the next slide, please. So this data is from Exelon's recent earnings presentation. I'm not going to take you through it closely, but I just, again, want to point out the significant variation between industries. And then if you'd flip to the next slide. So focusing on commercial real estate, this, time's up. So yeah, maybe we could, Kathy, do you want me to run through this real quick?
Yeah, we got time. Go ahead.
Okay. So it's a challenging time in the commercial real estate industry, and here are examples of what's being done. So we've got virus protection efforts. To dilute the virus to enter the building, owners are focusing on increasing the air change rate, increasing the use of outside air, and upgrading filters to MERV 13 and even HEPA filters. It's interesting to note that these three items by themselves can lead to an increase in energy usage, which is a tough pill to swallow for people who have buildings that are only partially or not even filled at all. A greater workplace spacing. For example, Ford told their employees to collect and clear their offices, not because they're being laid off, but they cleared out the offices and they're reconfiguring it for their eventual return. Touchless buildings, elevators, entryways, concentration points are a big issue. Owner liability, a very big issue. Someone gets sick, are they liable? Is the tenant liable? should they be taking employees' temperatures, and who's going to do it, and is it really that reliable given the number of asymptomatic cases? The economic downturn, we had a significant recovery underway, and it's kind of turned sideways. How long is that going to last? Stimulus efforts, and then will tenants come back, and will tenants make their lease payments, and will owners' employees come back? So if owners' employees don't come back, then what kind of example does that set? I just note that Twitter told their employees that they can work remotely indefinitely. REI is selling their new office building in Pacific Northwest to move to more regional offices, and and so will they make their lease payments? Will the flight to suburbia and beyond, is that a reaction or a trend? Customer credit's a big issue. And then last, I just note that ESG was a big issue, a growingly important issue before the pandemic, and it continues to be so among our customers, as well as interest in DER, it's distributed energy resources. So that's what I have. I guess the bottom line is, how do we regain trust, and when will that happen?
Excellent. That's just like a ton of high quality information to absorb. Thank you so much, Jim. We actually have a question here in the last 2 minutes of the time slot for your presentation from Alex, and it's very well written, so I'm just going to read it as it was asked. It says, today, electricity is primarily an energy market. We buy kilowatt hours, but all clean energy generators have high fixed cost, little variable cost. Should we not be shifting to a capacity market where we buy kilowatts? This shift is analogous to the telephony industry, where we used to purchase minutes. We now have fixed data caps. So what are your thoughts on that, Jim?
Well, I think if we knew the outcome of the MOPR, we know that answer for sure. But in a nutshell, I would say yes. I mean, think of it from a distribution company perspective. So what we're seeing are distribution companies are moving more towards demand charges rather than energy charges, which can kind of screw up some energy efficiency economics. But basically, they're looking for a more consistent return, which is sort of the flip side of what you're suggesting. And if you think, who knows what's going to happen to the nuke fleet, but as natural gas, assuming it stays low, renewable energy at almost, in many cases, zero variable cost, the market's going to have to rely on capacity payments to keep those assets functioning.
Right. Excellent. Well, we have to move on. Again, that was a lot of information to absorb. So again, remind folks, we're going to have questions at the end of all the presentations. So send a few more questions over for Jim and his presentation. Now we're going to move on to Pat Stanton, Policy Director, E for the Future. Pat is a nationally recognized award-winning expert in regulatory policy analysis and advocacy. Pat works tirelessly to improve public policies related to energy efficiency, renewable energy, and the full range of demand resources. Prior to E for the Future, she served as policy advocacy lead at CSG from 2003 to 2015 and led a consulting service for clean energy markets participants. Earlier, she was Deputy Commissioner at Massachusetts Department of Energy, DOER. So if you'd like to take it away, Pat, we're really looking forward to your presentation. Thanks so much for joining us today.
Thank you so much. It's really wonderful to have this opportunity. And I would like, I just have one logistics thing here. Here you go. So if you go to the next slide, please. So just a little note that E for the Future is a small nonprofit advocacy organization. We leverage our resources. We have an endowment from the sale of Conservation Services Group, or CSG, which was a nonprofit. We sold it to a for-profit company, and as a result, the purchase price became a small endowment for our nonprofit. And our hope is to create resources for the broader community as we all try to figure out how clean energy can best help us meet the challenges of climate change. So today I'm going to look at what's the status of energy efficiency in COVID looking at four questions, answering four questions. Why focus on energy efficiency? Where is energy efficiency sector 6 months into the pandemic? And why is energy efficiency a smart long-term investment? And I break that into two, looking at economic recovery via infrastructure, and then looking at climate mitigation via carbon reduction. So next slide, please. So this is why. I'm use Maryland as my example, given this is a Maryland-centric webinar, although I know that there are folks from other states and also potentially internationally on the webinar. So this information is from the U.S. Energy Employment Report of 2022. And clearly, energy jobs in Maryland are energy efficiency jobs. Now, not all states have this mix, although well over half of the states in the US have energy efficiency as the largest sector in the energy sector, the largest subsector in the energy sector. I'll also note that solar jobs in Maryland are about half of the generation jobs. Maryland doesn't have a ton of its own generation and imports a lot. So about half of the generation jobs in Maryland are solar jobs, but that's still only 6,800 as opposed to 68,000 in energy efficiency. So just to give you a sense of scale. Next slide, please. Now, as you might expect, most energy efficiency jobs are in the construction sector, whether it's new construction or rehab and refitting of existing structures. But I thought it's also interesting to note that over 9,000 jobs are energy efficiency jobs in Maryland are in the professional services sector. So these are architects, engineers, and bankers and other types of financial services experts. And that that's pretty common across the country. So there's a large professional sector supporting energy efficiency. Next slide, please. So this is the historic growth and dramatic drop of energy efficiency jobs in Maryland. E4 has co-authored the Energy Efficiency Jobs in America report for the last 5 years with our partner E2. And so we have this breakdown data, and we got together in March when we saw those extraordinary unemployment figures and realized that we had the backbone of information about energy jobs and clean energy jobs to be able to analyze the Bureau of Labor Statistics monthly report, as well as the weekly filings for unemployment reports, and provide a good view of how the clean energy sector has been impacted. And so we've working with ACORE on this report, have published every month. And we see that, you know, dramatic job loss in Maryland with, you know, not only wiping out all of the gains over the last 5 years, but far more than that. So we currently have a lot of skilled, qualified workers in Maryland who are on the unemployment rolls. So we're hoping that there'll be good public policies to get those workers back in the field. Next slide, please. So why do we think that energy efficiency is really smart for economic recovery? And so first is speed. getting workers back to work quickly is really important. And we know that energy efficiency projects, don't require siting. Permitting is generally a pretty low bar compared to a lot of energy sectors. And so it's, from a technical point of view, it's pretty easy to get folks back to work. And certainly skills, as the previous slide pointed out, there are a lot of skilled, experienced energy efficiency workers in Maryland who are currently unemployed. And if there were investments in infrastructures such as our schools and so forth, there would be workers to get going on those projects quickly. Safety is obviously a paramount concern today with COVID. And we're a sector that has dealt with a lot of health and safety protocols in our work on a sort of day-to-day basis. We have our folks are dealing with spray foam insulation or other types of insulation. They're crawling around in attics. They're working in basements. There are a lot of situations where PPE is required just to do everyday business in energy efficiency. In fact, a number of energy efficiency companies in March and April donated all of their PPE, including their masks, to their local hospitals in the early stages of the pandemic, which actually created a real concern as we're trying to get back to work. And one of the companies in our field that does a lot of processing of rebates on and shipping of things like light bulbs for utilities has become a central procurement and distribution for PPE for the energy efficiency industry. And we're quite hopeful that that will help accelerate getting the workforce back. And finally, over the last 3 months, there's been a lot of work, including DOE and many states, to look at adapting our safety requirements to take into consideration not only the safety, worker safety, but safety of occupants in the building. And will be, I think that work tees us up to be ready to really hit the ground running if there is a stimulus infrastructure package. Scope. Every county, every community in Maryland, in any state in the US, has old buildings. And old buildings have always are a key opportunity to do energy efficiency work. So whether it's publicly owned buildings, privately owned buildings, commercial buildings, residential buildings, there's a lot of opportunity. And finally, scale. That opportunity is practically limitless. We don't throw out buildings. Even cars are, have a sort of maximum life of 20 years. Buildings stay for, decades, sometimes hundreds of years, and they have to be maintained. So the next slide, please, just to give you an idea of the opportunity in Maryland. There are lots of old school buildings with an average age of over 30 years. I'm pretty confident that any building that's over 30 years old has opportunities to upgrade their HVAC systems, to upgrade their lighting, and to provide a better indoor air quality and working environment for the students and the teachers. And even if we were to just tackle those that are over 30 years old now, so that's 700 of these, they're multi-million-dollar projects doing even 70 a year would be an astonishing amount of work. And residences is residential energy efficiency, particularly as the trend, if the trend for working at home continues, then, and there's a larger share of the energy consumed in residences, having those residents be energy efficient is going to become more important. So, and again, they're old. And a lot of them require upgrades anyway. Any percent of if the average HVAC system has, let's be super conservative, had a lifespan of 20 years, doing 5% of 2 million homes every year would be an astounding amount of work. So next page, please. So we got together with our partners at E2, and after publishing the first job loss report, felt that it was important to not just be sort of the Debbie Downer of the energy sector and talk about the job losses, but to take the opportunity to really think about, if there were a robust investment in clean energy as part of a stimulus package, an economic recovery package, what could it look like? And we developed a portfolio of energy efficiency initiatives that primarily used existing vehicles, such as the weatherization program or state energy offices, took a hard look at the programs that were run under the ARA investment, and came up with a $60 billion example package that would address commercial, residential, the municipal and institutional market, a balanced portfolio. And of that portfolio, the proposed impact on Maryland, as an example, would really be substantial. So we were able to run the model to look at both the jobs impact and the economic impact of doing a major investment in energy efficiency as part of a Recovery Act. So 10,000 jobs per year for 5 years, a total of 50,000 job years. Always when you do this analysis, should you present it as permanent or long-term jobs, same job for 5 years, or do you do job years? But it's a lot. We're looking at $4 trillion in economic benefit to the state of Maryland, should there be this kind of economic recovery investment. So happy to talk to folks. We also, E4 is in a position to help states look at some adjustments to the scenario, to look at potential impacts of different portfolio of energy efficiency investments, and happy to follow up on that if there's interest. Next slide, please. One of the big things that we wanted to look at was leverage, because energy efficiency is really unique in among the investment opportunities in clean energy, and that is there's a strong, experienced infrastructure for an industry that provides loans to do the work, so that you get the economic benefit, the quick hit of getting people in to do the projects now and get that economic boost at a time where we need that kind of economic recovery. And then the project actually gets paid for by the loan being paid off by the energy savings that the owner of the facility experiences. And that can multiply the actual amount of work compared to the stimulus dollars by, over 3 times. And we felt that was really important to point out, or over 4 times, excuse me, point out to policymakers. We know they're going to be under all outcomes of the election in the fall. There are going to be a lot of new members of Congress because there's so many retirements. So we're really laser focused on educating new members about the leverage potential for investing in energy efficiency, putting the financial industry to work as a strong partner so we can get many more workers in the field in the short term and pay for those projects over time. Next slide, please. So climate. Why should energy efficiency be top on the list? And next, click, thanks. So I don't know, some of you may have seen this Bloomberg headline. It came out almost exactly a year ago. I think it was right after Labor Day. Basically saying that natural gas plants would get crushed by a combination of wind and solar. And this is a study done by Rocky Mountain Institute. And as is often the case, next slide, please, the devil's in the details. And it turns out that it really isn't wind and solar that's going to crush the gas plants, but a combination of wind, solar storage, and energy efficiency. And this graph, which is the first graph in the report that's published by REI, and the source is provided there for you all, shows 2 scenarios. One is wind, solar, and storage. So that's the light blue line, and shows when in time it's likely that those technologies will match exactly the price to where you can build a portfolio of those technologies that would provide the exact services that natural gas plants would provide. So ramping, quick start, all of the functionality of the proposed natural gas plant. And as you see, they're talking about 2030 as the point where wind, solar, and storage would be cheaper than building new, or would be this cross the line to be exactly the same price as building a new natural gas plant. What's really interesting.
This is Lee. We're getting close to our
Okay.
time for question here, so appreciate your information.
Okay. So the clean energy portfolio, which is just the clean, wind, solar, and storage plus energy efficiency, actually tests that goal today. And if you look at the specific information for Maryland, if the share of the portfolio for the clean energy portfolio in Maryland in terms of dollars spent, it was only 4%. But in terms of megawatt hours delivered and therefore climate reductions, it would be 38%. So energy efficiency plays way above its weight, produces a lot of returns, can't do the job by itself, has to be in partnership with the wind, solar, and storage and other clean generation, but it really makes it much more feasible to get to the answer we want to get to. And so with that, I'm done.
Great. Thanks so much, Pat. Tons of excellent, thought-provoking information. We did get a few questions dealing with equity and energy efficiency. but I'd like to hold them for now,
Sure.
just if you wouldn't mind, just to keep us on track. So let's move on to Gregory Wetstone, and thanks again, Pat, so much. Gregory Wetstone, President and CEO of ACORE, renewable energy consultant advisor to the stars. I've known Greg for a long time, and he's president and president and chief executive officer of the American Council on Renewable Energy, otherwise known as ACORE, which of course is a national nonprofit organization that unites businesses, policy, and finance to accelerate the transition to a renewable energy economy. Prior to joining ACORE, Greg oversaw government affairs as vice president for TerraGen Power LLC, a renewable energy company with utility scale wind, solar, and geothermal energy facilities. Previously, he served as Senior Director for Government and Public Affairs at the American Wind Energy Association, or AWEA, and Director of Programs at the Natural Resources Defense Council, the good old NRDC, where he founded the legislative program. Earlier in his career, Greg was Senior Counsel to the House Energy and Commerce Committee. Greg has a JD from the Duke University School of Law and a BS from the Florida State University. And Greg's going to give us a really interesting presentation on the policy side, particularly as things are shaping up in DC. So Greg, we're really looking forward to your presentation.
Thanks a lot, Lee. I'm thrilled for the opportunity to participate this morning, and to join you and Jim and Pat is really an honor. So it's certainly an interesting time, and happy to give kind of a quick overview of where we are in the renewable sector. So if you could advance the slide, please. I'll just call those out as they come. Lee gave a great overview of what we are at ACORE. We're promoting the transition to renewable power with every tool we can, and that includes finance, policy, and technology. Next, please. Want to start off, next slide, please. Thanks. I'm going to spend a longer than on the other slides on this one, which is really the snapshot of where we are in the renewable sector going into COVID. So through 2019, last year, 21,000 megawatts of new wind and solar were brought onto the grid. That's a very big number. It's the second most ever. That's happening despite the very low gas prices that Jim conveyed so well, despite the reality that electricity demand in this country is flat, and since COVID, well, it's more complicated than that, but basically, fundamentally, we're not growing in our electricity demand, and we can thank Pat and a lot of the great efficiency in part for that. And yet renewable deployment is growing rapidly, almost evenly divided between wind and solar, a really healthy situation in that regard. And I do note the 8 gigawatts for the first half of 2020, that's pretty credible. Typically the years are backloaded, so we usually see a lot more deployment in the second half of the year. Next slide, please. From an investment perspective, last year was a record, over $61 billion. So the investment in renewable power is a major driver for national economic growth. And we saw that through previous downturns in 2009 and 10. And we feel like the renewable sector is positioned to help our economy grow again, consistent with Pat's Build Back Better thesis. We do have that capability. Prior to COVID, the 2 fastest growing job categories in the country were solar power installer and wind turbine technician. Next slide, please. This is just to demonstrate, it's not just here, this is happening globally. $291 billion globally last year invested in renewable power, on the order of $3.5 trillion globally. So this is a real business, real money. This is serious stuff here. And this sector continues to grow. Next slide, please. In Maryland, just to put up some state-specific data, more solar than wind, 16th in the country in solar, 32nd in wind. We're seeing, so that's about 5% of the state's portfolio right now. That's growing pretty rapidly, and obviously we'll see big changes, not only with more solar, but if we get to the offshore wind that's in the mix right now. Next slide, please. In terms of dollars, you see we're over $3 billion invested in solar and about over 400 million in wind. This is data is as of Q2 of 2020. Next slide, please. So, enter COVID. Pat described the job situation well. We have been working with E4 and also E2 and BW Research in releasing monthly job data, looking at the impact on the renewable sector in particular. We've lost 81,000, almost 82,000 jobs since March. That's a lot. We think the lion's share of that is in distributed solar. The Bureau of Labor Statistics, who tracks this data, doesn't separate among the types of renewable power, so we can't say for certain, but we think most of that job loss is in the distributed solar realm, where understandably folks are nervous about bringing other people to their house or business, and it's pretty parallel to the problems in the efficiency realm as a result of the pandemic. When you're looking at scale development, like the projects behind me and the graphic here, you see some real problems and difficulty completing project delays, siting, permitting is just slower, social distancing just makes it tougher. There continue to be hiccups in the supply chain that make it hard, particularly when you have very tight deadlines to complete projects in order to qualify for tax credit. Another big area impact is the tax equity investment that is really critical to monetizing the tax credits that are so important to growth in the renewable sector. As I suspect most of those in the audience today know, we don't really have a national energy policy for a certain level of renewable energy, unlike most of the rest of the developed world. Our energy policy, for the most part, is lodged in the tax code. And to make those credits real, we need complicated financial transactions that bring in tax equity advisors. They're basically lending against what they expect to be their big tax bills. In the pandemic environment, a lot of folks aren't sure what their tax bills are going to be. They're not sure how much money they're going to make, and they're reluctant to do tax equity lending. There's still some big players out there, but the market is constrained, and that's a real concern. A silver lining here is that sustainability investing has continued to grow, and if anything, that growth has accelerated in the pandemic as ESG funds have fared better. They tend to be longer time horizon considerations, and that tends to be more resilient to the pressures like a pandemic. So those funds have outperformed the marketplace and have broadly and continue to grow. Next slide, please. So just a moment on unemployment in Maryland, not too far afield from the national average, about a 12% decline. More of that in the efficiency sector by far than in wind and solar. Next slide, please. So where does that leave us? This Bloomberg NEF lowered their projection for 2020, and they're now predicting on the area of 23 gigawatts. That's significantly below where they were, 20% below almost. But it's worth noting that would be a record year. That's still an increase over 2019. Almost 23 gigawatts of new renewable power is pretty huge. So what we're seeing is slower growth than anticipated, but still substantial growth, and really powered by scale wind and solar development. Probably 2020 is going to be another strong year for wind and solar power. Next slide, please. So I mentioned tax equity investment. At ACORE, every June, every summer, we do a survey of the biggest investors and developers in the sector. And we ask a range of questions, including where they see the greatest concern for investment in the coming year. And by far, that concern is on tax equity investment. So on all sides of the transaction, there's worries that there may not be enough tax equity financing to keep the sector growing at the level we want to grow, much less the accelerated level we need to grow if we're going to be serious about the climate problem. Next slide, please. So COVID legislation, Congress may or may not be done for the year. There's still a real potential they'll come back and move additional COVID response legislation. We're certainly hoping that's the case. We think if they do, we're positioned to get some help there. And the primary ask is to make those renewable energy credits refundable so we can deal with the constrained tax equity market. Refundability would restore liquidity, and I think we'd see a lot of growth, and that can help realize, our objective to see renewable energy helping drive the economic recovery in this country, and of course paving the way to a real climate solution. We're also seeking a delay in the phase down and out of renewable credits. The way our tax code works, after about 2023, there will be no credits for renewable energy except for a 10% solar credit. Everything else phases out, and all the fossil credits that are in permanent law will remain in place. Do want to mention that we did have success with the Treasury Department extending the safe harbor period, which is the deadline for completing projects in time to qualify for the tax credits. Used to be you had to do that in 4 years. They provided an extra year. So 2016 and 2017 vintage projects, and this is really relevant to wind in particular, have a little more time to get completed. This is huge given the delays associated with the pandemic. So we're grateful to Treasury for that help. Next slide, please. Just wanted to put the climate agenda out there. This is, at ACORE, we did a report called Advancing America's Climate Leadership that identified a range of key policies that we need to grow at the level that scientists say we need to grow for the climate problem. What we see is several of the key aspects have been incorporated in various House legislative proposals, as well as the Senate Democrats Special Climate Committee put out a report that endorsed all of our recommendations. We're thrilled with that. They include upgrading to the grid, streamlined siting, as well as a technology neutral tax credit, carbon pricing, and a high penetration clean energy standard. It is notable that Joe Biden has such a standard. Next slide, please. I was asked to provide for this group a quick contrast of the presidential candidates. This slide is our attempt to do so in a succinct way. No surprise here, it's a pretty stark difference from the aggressive clean energy standard from Vice President Biden to the repeal of the Clean Power Plan from President Trump. Biden wants to rejoin Paris. President Trump withdrew. I suspect our audience is intimately familiar with these. I do want to, next slide, please, mention the range of regulatory policies that are increasingly a concern in the renewable sector. They include, we were talking about capacity markets. We'd love to see renewable energy compete aggressively in the capacity market. The price floors that FERC has introduced in the PJM market and in a different respect in the New York ISO are a big problem and really discriminate against renewable energy and undermine the ability of states to choose their own electricity resources, which is a fundamental tenet of the Federal Power Act. So those are big problems. We have the executive order in bulk power that threatens certain electricity equipment, particularly transformers. We have a recent rule discouraging ESG investment by pension fund advisors, and a range of tariffs that seem to particularly hit renewable energy hard. So all that is, those are complications if you're looking for a stable business situation. So with that, I think I'll wrap up. Happy to deal with questions, and again, appreciate all of you taking the time to join today and the opportunity to be with Lee, Pat, and Jim on the panel this morning.
Excellent. Thank you so much, Greg. And we do have some questions that came in. While we're waiting for the closing Q&A discussion, we'd like to share the results from our earlier polling questions. So please continue to submit any additional questions via the Q&A feature on your menu bar. So 5 years from now, do you foresee commodity electricity prices? It looks like about the same as what the projection was there, 61%. That's interesting. Polling questions 3 and 4. June 2021, that's when everybody expects the majority of workers to return to offices. So that's coming sooner than we actually think, but still too long, but it is what it is. That's an interesting result. All right, let's dive into some questions for the panelists. I've got a few for Pat, and Pat, one, Laura asked actually 2 questions. The first one is, can you speak to equity in energy efficiency and the connection between indoor air quality, health, supporting low-income family to pay bills, etc.? So equity in energy efficiency and the connection between those things.
Sure. So we look at equity in 2 ways. One is the equity of delivering services to customers, and the other is equity in the workforce. And I would say in both cases, we have a lot of opportunity to improve. And we actually, for the EE Jobs in America report this year, we're hoping to have the first demographic data by state that we'll be able to share and provide at least a snapshot picture of the workforce question. Certainly on the low income issue, we all know that low income folks spend a lot larger percent of their disposable income on energy efficiency than the rest of us do. And so energy efficiency investments provide an opportunity for low-income customers that is disproportionately great on a financial side. It's also issues of indoor air quality, very strong where there's asthma in the household. So the benefits of energy efficiency, sometimes when you start talking about the indoor air quality and the health benefits, as well as the economic benefits, some folks kind of think, well, you know, it can't be that good, so they must be making stuff up. So we have focused in our work on the jobs and economic benefit issue, but I'd be happy to point you to a couple. In fact, there's a really good new guidebook out by VEIC on how programs can include more air quality concerns, address more air quality concerns through their energy efficiency programs.
Excellent. We had another question, Pat, which I think is in your wheelhouse. It reads as follows. It's worth noting that the MDGA, and you may want to define what that is for our listeners who don't know, set aside an additional $6.5 million for low-income energy efficiency during the last legislative session. Apparently, Maryland is waiting on the governor to release those funds. The question is, can you talk about why the governor should prioritize this from a climate, economic recovery, and equity perspective?
Well, absolutely. Just as I was saying, low-income households gain the most from energy efficiency investments. And it does require more of support from the general public to get that work done. So it's really important. And in order to reach all of the while Maryland has had a strong low-income program, it still only reaches, 1% of the low-income households in a year. So any additional funding would be a tremendous asset to the community. And just to get back to the good old dollars and cents, low-income folks who have extra $30 a month because of energy efficiency are going to spend that money in the community.
Right.
So it's a real benefit to the community to increase the amount of money that's available for small businesses and restaurants and so forth.
Yeah, I know. That's one of the things that I actually commented on to the Office of Comptroller of the Currency. They're a banking regulator which recently had put out some guidance and some question and wanted some feedback from the community about low and moderate income communities. And I had made that point in the filing that I had submitted, which was that investments in these low and moderate income areas do have an economic multiplier effect that really does need to be acknowledged and supported. So I think that's a really excellent point that is often missed, but it's common sense, but it's very important. Greg, I think we have a question for you. The question, of course, is, has anyone seen a breakdown of the Democrats' proposed $2 trillion infrastructure plan? The questioner says they mentioned building energy and transportation retrofits during the convention. So maybe if you could sort of maybe give an indicator as to where this person might go to find the detail and then say something about that aspect of it, if you wouldn't mind.
I'll do my best. I think I think the answer is someone probably has seen the detail, but not me. I'm not sure that it's out there publicly. I've seen some really encouraging language about investing in the energy transition, investing in an expanded and upgraded national grid, which we think is really important. We have, at least I haven't seen the details there. I would add there that kind of investment is consistent with and actually would be essential for the ambitious transition period called for in Vice President Biden's clean energy standard, which calls for 100% carbon free by 2035. So all that is at least, so our knowledge, not yet fully fleshed out, but certainly laudable directionally. The numbers sound good, and we look forward to seeing more detail and doing what we can to provide whatever help we can in fleshing those programs out should Vice President Biden be elected.
Yeah, no, that's a good point. And, you know, I actually recall seeing a document. I don't know if it answers this question, but in the relatively recent future, there was a document. It may have been from the Congressional Research Service, the CRS, which was a scoring of some legislation, and it had scores for certain clean energy proposals. So the questioner may want to go on the hunt, start maybe with the Congressional Research Service, but I think there is some scoring. I can't remember if it was a CARES Act bill or if it was the Moving America Forward bill or what, but there is at least some scoring out there that might help you. And then secondly, to that same point, the Congressional Research Service is starting to prepare reports on these topics for members of Congress because obviously they're wanting simplified explanations of it. So for those that aren't familiar with that service, I'd recommend staying tuned to the Congressional Research Service. Greg, there's another question here. It is asking if you could share any insight on the proposed National Climate Bank being advanced by Senator Van Hollen.
Yeah, I mean, that's part of a package of efforts to create greater public-private partnerships in renewable energy development. It's a complement to the existing. There's a loan guarantee program at the Department of Energy that's still sitting on $40 billion that could be well expended, including, you know, right now to help promote growth when our economy really needs it.
Right.
And it's also, I think, a good complement to a technology-neutral tax credit for carbon-free generation, which is something that we think would be very helpful as a complement to other measures.
Yeah, keyword complement there. Jim, we had a question on the comprehensive data that you provided. I mean, obviously, there's like so much there to contemplate, but the question was, it may or may not be two questions. I'm going to tell you both and let you decide how you want to answer it. The first question was, of all the data that you submitted today, what aspect did you find most interesting? And maybe the opposite side of the same coin, what is the most concerning aspect of what you shared with us today?
Well, I'll tell you this real quickly. What I did find, excuse me, interesting was the poll results. So if you go back 10 years and before, and you asked a person walking down the street what their view was, what their view was of where energy prices were headed, 9 out of 10 would say they're going up, or energy prices always rise. And I mean, it was, I used to sort of keep track of this. For a while, I kept like little notes on like how frequently I heard this in writing or in person. And so today the answer is about the same. And so, but you know, 10 years ago, people expected energy prices to keep going up, and they fell. Now people are expecting, you know, it's like the pendulum has swung. People are expecting prices to stay about the same. You know, that's kind of a contrarian signal to me that maybe prices are going to start going up again. You know, it's just when we get used to it, and you know, that's when things often turn around.
True.
I guess that as far as the things that really stood out to me is the advances in technology. I mean, it's just stunning. So when people think about where energy prices are headed in the future, you know, on that survey, really, there was no correct answer. You know, you can justify each of those options. And, you know, if there are further advances in technology, it could lead to even further declines in energy prices. At the same time, you know, there's just all these other factors out there and uncertainties that in the short and medium term and even long term could drive prices back up again. So, I mean, it's been a phenomenal 10 years, you know, with the unleashing of advancing technology. I just think, you know, it's just really hard to predict where we're going to end up. As long as we have a free market and, you know, entrepreneurs can be rewarded for their efforts.
Yeah,
Greg,
Yeah, I just wanted to jump in and really back that point. I mean, between economies of scale and technological improvements, including a lot of software, we've seen the levelized cost of wind energy drop by 70% over the past 10 years, which no one predicted. And 10 years ago, they were looking at, marginal changes with bigger blades was really what was anticipated. Instead, we've seen this massive change. And then in solar, it's a 90% cost reduction over that same 10-year period. So tremendous progress there. But I would say that with tax credits phasing down and out and tariffs threatening a lot of different components in the value chain, the pressure on energy prices gets tougher and tougher for renewable developers and others. So, and it's hard to know when you can have those pressures. That doesn't mean prices will go up, but there's reason, business reasons why, from the standpoint of the sector, it wouldn't be a bad thing. And obviously higher prices would also promote more efficiency, which is a good thing too.
Right. And actually, I'm going to come back to you on that, Greg, with a follow-up so you can think about your answer while I go to Pat. I wanted to ask you, or I will ask you to maybe comment on the distinctions between the Biden energy policy paper, the Democratic Party platform, and the reality of what people are going to actually do in Congress. So I'll come back on that one. But Pat, we've got a question here for you. It's asking if you could provide some examples of good public policy. What public policy would be able to get energy efficiency workers back to work? So if you wouldn't mind, give us your thoughts on that.
Well, certainly, I think there's state. I'll talk to state policy. So I think there are a couple of really important things. One is, doing energy efficiency on a building. The building owner gets some of the benefit, but a bunch of the benefit goes to us all collectively because the whole system needs less stuff. So saying to building owners they should do this is kind of like saying, and you should build a swimming pool in your backyard and let the whole neighborhood come. It's so the whole neighborhood has to chip in, and we've learned that from history. And so I think thinking about how states want to fund this, and there's some examples where you disconnect pricing, so you can have the lower energy costs, or you can have energy paid for more on a capacity level and still fund energy efficiency and motivate people to do that work. So I think that rethinking how the community contributes to energy efficiency is super important at the business level in the states. States like Massachusetts, where it's required by law to do all cost-effective energy efficiency, they fight about what that means. But once they decide on that for a given 3-year period, it's charged to the utilities charge it as an operational expense. Basically, and it's not a CapEx, it's an OpEx kind of expense, but it isn't capped by some system benefit charge or whatever. They collect what they need to do what they're asked to do. And as a business person, one of the things that I thought was really interesting is the quarterly earnings reports for the New England for the Massachusetts utilities. I got an insider piece of information that about 2 years ago, for the first time, the pie chart of profits, sources of profits that was shared on the quarterly earnings report, energy efficiency had its own very own pie on the pie chart. And that really changes how the CEO, how shareholders and investors think about energy efficiency, and it's growing. So that really changes the dynamic for energy efficiency. And I think thinking of that business model is really important.
Yeah, that makes a lot of sense. And I know we're starting to read and see it more and more about the social responsibility aspects and even the legal liability and shareholder litigation that may result to companies that don't maximize all their energy opportunities, whether it be clean energy and or energy efficiency. So certainly that's going to also be part of the new normal at some point in time. Thank you for that, Pat. Greg, so back to you on, you put up some really compelling slides showing, the Biden policy platform as it stands today, which of course is, the epitome of a political document if there ever was one. We know that, presidential budgets are actually always just a talking point. They almost never get implemented. We know the political party platform is even more of a political document, which has very little, if any, actual influence on, at least on energy as I've seen in my history. But then we have members of Congress who talk to the people in their districts who are lobbied by the solar and wind and other energy companies in the renewable space that actually create the jobs. And so I just wondered if you could, give us some perspective on maybe sort of a reality check on how quickly the Congress might depart from its current method of supporting renewable energy, which is through tax policy and in particular tax credits.
Yeah, obviously a lot's going to depend on not just the presidential election, but what happens in Congress, what happens in the Senate in particular is going to be important there. Who has the gavel? If Chuck Schumer has the gavel, it's going to be a different world for these policies than if Mitch McConnell does. I think in the scenario where you have a Democratic Senate majority and a President Biden and a Democratic House, in that scenario, I think some things could happen very quickly. I would not be at all surprised in that scenario to see, say, a budget reconciliation bill move very quickly that would have infrastructure components, tax components, and it's not clear how much could be done toward the clean energy standard. But I think you could see a lot of pretty rapid change. I think the numbers in terms of bipartisan support for policies that promote renewable energy and energy efficiency are overwhelming in both parties.
Right.
And there's a lot of polling for that. And just to level set with where we are, ARENA, the International Renewable Energy Agency, put out a report yesterday that said that their global subsidies for fossil fuels were pegged at 3.1 trillion, which is 20 times the level of government support for renewable energy.
Wow.
And that ratio is not that different here in the U.S. So
right.
A lot of it is, are we directing our resources toward what we think is the energy profile of the future?
Excellent. Thank you for that. Well, we're actually 1 minute over our allotted time, so I want to just first of all thank our panelists and their time and effort put into the content, which is extremely valuable and really compelling, and also to thank everybody for joining today. We hope that you have again an opportunity to learn something new, and hopefully we'll see you at a future session in MCEC's Connecting to the Energy Economy speaker series. So with that, I'll close it out and give everybody a great thanks and wish everybody good health and continued prosperity. Thank you for your time.